Options Made Simple, the Charting Wealth Way. Part 1, how options work. Caveat we always give with options: if you can't read charts and you can't make successful practice trades using shares of ETFs and stocks, my friends, you're just not ready for options. It's critical that you understand weekly vertical crossovers, that you understand how to employ them, how to properly find buy-in points, sell points, that you know how to use our profit and loss bands, that you are a good chartist, that you understand technical analysis, because if you don't, you will lose every penny you put into options. And you're sort of wasting your time even spending energy on practice trading options if you can't first successfully practice trade stocks and ETFs. You've just got to do that first. Critically important. What are options? Options are nothing more than contracts. An option allows you the right, but again, notice this, not the obligation to buy, that is a call option, or sell, that is a put option, a security at a set price. That price is called the strike price, until an expiration date, after which the option becomes worthless. Now, for those of you who aren't lawyers and don't really understand the whole concept of contracts, you don't own anything like an equity with an option. When you buy a stock, even if it goes down by half, you at least still own the stock. It doesn't expire unless, of course, the company goes bankrupt. Options, however, are contracts for set periods of time. And as I said earlier, it gives you the right, but not the obligation, to buy, and that's a call option, or to sell, that's a put option. Now, let's think that through. When we talk about call options, it allows a trader to buy a security at a set price. So I want you to just have the concept in your mind, because it's critically important that you understand this. We'll just say XYZ Corporation, you buy the $100 strike price, which allows you to purchase so many shares, and we'll talk about that later. But it allows you to purchase the security up until a set date. Might be a month away, might be 5 months away, okay? You determine that date. It costs more for more time, of course. But what it allows you to do is to purchase XYZ Corporation at that strike price, and as I said in our example, it's $100. So what does that mean for you? Well, it means, think about this, conceptualize this. If that $100 XYZ Corp stock goes up to $110 within that time period before the option expires, think this through, that means that that option at a $100 strike price that's gone up to $110, what's the value that you now have implicit with that? Isn't that $10 per share that you have the option to buy? That's pretty cool, isn't it? Now, there's a fee for that. We'll talk about some of that in a minute and get into more of it in later parts of the series. But that's what a call option is all about. It gives you the right, but not the obligation. You don't have to exercise your option, and you can exercise your option anytime during the period of the option, but it gives you the ability to buy a security, a stock, an ETF, whatever it might be, at a set price. Pretty cool. But what happens if the value of the security goes below $100? Well, the value of the option, the call option, starts decreasing. It decreases if it goes under $100. So you can start losing money. If it goes down to $90, well, of course, its value's now at least $10 less plus what you paid for it. So again, there are problems with that. You can understand that, right? You don't own anything, because if indeed you end up letting it expire, it's worthless. And if you guess wrong, and again, we don't want to guess, we want to follow trends. That's why I say over and over again, you have to understand how to buy and sell and how to chart. just regular stocks and ETFs, how to practice trade those before you can even think about options. Now let's talk about put options for a minute. Put options, the opposite of a call option. Think this through. It allows traders to sell a security at a set price. Let's go back to the $100 of XYZ Corporation stock. You have a strike price of $100, which allows you to sell a security at $100. That's what your option lets you do. Now think this through. What if the price goes down, not up? You think, you look at your charts and you determine, hey, this is rolling over, price is going to go down, so you buy a put option. It allows you to sell, now this is bizarre, this is where it's hard for some people to catch it. It allows you to sell something you don't own at a set price. That's what's so beautiful about it. So say XYZ Corporation, you have a $100 strike price, the stock's at $100 and goes down to $90. Now think this through. It allows you to sell something you don't own at $100 when its value is $90. And effectively, you get the benefit of a pretend buying it back at $90, which puts, again, $10 in your pocket, minus the cost of the option and these other things we'll talk about in a minute. But it's just important that you understand, even if you don't want to think all of that through, just realize that put options, you want the price of the underlying security to go down. Call options, you want the price of the underlying security to go up. Always remember, options are bought in this mode of thinking to be sold. In other words, we don't want to buy them to exercise them to have the stock. We want to buy them to watch them go up in value, to sell the options before the expiration date, and to make money off of them. Now, let's talk about how options are priced, because I alluded to that just a minute ago. We have the intrinsic value, and that is the strike price in regards to the value of the security. And in the next training, we're going to go over in the money and out of the money options. But the strike price is, again, very important when we start looking at the value of the options and how that strike price is compared to the actual value at the time you purchase the option in regards to the security. If you purchased a call on ABC Corporation and you bought the $100 strike price and the value of XYZ Corporation stock is $110, think about that. You're already $10 in the money. We'll talk about in the money and out of the money. But when we talk about intrinsic value, just remember that deals with the strike price in regards to the value of the security. And again, with call options, we want them to go up. So when we have the value of the stock greater than the strike price, we're already in the money. We already have value. That's the intrinsic value. The opposite is, of course, true with put options. If put options, when you buy that, if the price of the underlying stock is $90 and you have a $100 strike price, well, you're $10 in the green, as you might think of it, or in the black, not in the red. So keep that in mind as we move forward. Now, extrinsic value. This is where we get into some of the real mathematics on how options are calculated and the complicated nature that can be involved in them. Something called implied volatility, and also the days left until expiration. Remember, the further away in time that you have to see the option move the way you want it to move is going to, of course, cost you money. It's called the time value of money. If you buy an option that's going to expire in a week, well, of course, it's going to be cheaper than an option that gives you all this time to exercise it 5 months later. Implied volatility is based on supply and demand of options also. What do we mean by that? That's where this implied volatility. If there's a lot of movement in the stock up and down, then you've got a great deal of volatility and there's more risk for the people that are selling the options. Not buying the options, but actually providing the options, providing the underlying assets. So they've got more risk with price swings. So consequently, you're going to see the extrinsic value, the extrinsic costs go up in that regard. Also supply and demand. How many people want these options? If you see very thinly traded options, of course, that's going to lower the extrinsic value and the cost than ones that are of great demand. And again, limited supply. So keep those things in mind as we move forward. And here's the really good news. Commissions used to play a much, much bigger role in option pricing. What we've seen lately, those who've been paying attention to the news, is that so many of the firms that sell options, whether it is Charles Schwab, whether it is TD Ameritrade, whoever it may be, many of them are going commission free. Is that not beautiful? You still have to pay a price. You still have to pay the extrinsic value, extrinsic value of the options. The options have a price themselves, and there are costs. But as far as the commissions themselves go, many of those are being reduced or eliminated, which again means less you have to earn. It's less taken out of your profits. So that is beautiful, and that again is opening up the door for the ability for you to actually make more money in your practice trades. Now, we've got a lot more to teach you when it comes to options. This is only the first part of a multi-part series. We're going to be jumping into all sorts of interesting things in the next versions. We're going to be talking through all of this, helping you understand how options are priced, of course, how options are traded, how they work, and again, how to practice trade them and understand them fully. We love to hear from you. Chartingwealth.com is the website. If you don't have our book, Charting Your Way to Wealth, go to the website, check it out. And if you hadn't signed up for and aren't receiving our daily market reviews, 10 to 15 minutes is what we ask you to spend with us to actually understand how we do what we do and how to chart. Please make sure to go to the website, sign up for that for free. Get yourself on our mailing list and receive those daily video reviews, plus the special trainings that we do, one of which you're listening to right now. God bless, my friends. All the best from the whole team at Charting Wealth World Headquarters.